Okay, so in your test, if you are asked to use the MACRS method to suffer depreciation and the NTV, this is something you should do. For example, in the Swiss case, we have a 5-year project, so the equipment lasts for 5 years, so it falls into the category of 5-year assets. If I'm going to use MACRS to calculate my depreciation, not only my annual depreciation is going to change at different numbers, but also the ending book value will change. So right here, let me just change it back and everything back to the original format. And I want you guys to observe this ending book value. Sorry, make it yellow. Okay, and also the depreciation each year. All right. So this is 5-year assets. So I'm going to use the MACRS table designed by the IRS, and here are my numbers. You see, this is for 5-year assets class. So 20, 32, 19.2. All right. So this is something I'm going to do. I'm going to use a blank row. I call it MACRS percentage. All right. So basically, in year 1, it is going to be 20. In year 2, it's 32. In year 3 is 19.2. In year 4, it's 11.52. Okay. And in year 6, which is also the ending year, that is 7.76. Okay, 5.76. All right, these are in percentage. And these are numbers. Well, I should also add percentage sign there. Or I can just divide it, the whole thing by 100. Okay. All right. So for the annual depreciation, I'm going to use the beginning value of the machine, which is $1.5 million. So that's the $1.5 million. I'm going to lock it, okay, multiplied by all this percentage for the first 5 years. So to get the annual depreciation in dollar figure, the first one is this. Okay. So the first year, the depreciation is $300,000. Okay. And then I drag it, it accelerated to for $50,000, for $80,000, and then the third year is $228,000, so on and so forth. Okay, and it's not just the annual depreciation changes. The last year would have a different ending book value. So the ending book value right here equals to that percentage, okay, the ending book value percentage multiplied by the beginning value of the machine. So basically, the ending value will be $86,400, and that's basically change my capital gain. You see, the capital gain again is salvage value of $300,000 minus the ending book value, and then my tax on capital gain would also change, and that basically changes my NPV. All right, so this is MACRS for now, and now let's jump to this another part of this chapter, which is risk analysis. So basically, we are not sure whether the number we are getting for NTV, including all the operating cash flow, the salvage cash flow, and change in net working capital, will be solid. There is always risk getting involved. So there's a lot of uncertainty. And we have these 3 types of analysis to handle uncertainty. Okay, we cannot control those riskiness, but at least we have an idea of how we can get affected by the risk. Okay, the first one is a sensitivity analysis. So what you see here is basically it's a what-if analysis. What if some variable changes? Okay, what would be the dangerous variable? Let's say sales definitely is a very important variable because operating cash flow is purely determined by sales. So if sales drops, then that would affect my operating cash flow by a large scale. So for example, in the Speedo case, if the sales drop by 8%, So the first year, the revenue, which is sales, drop by 8% would be the new level, okay, 36 and 80. And then the second year, drop by 8% would also um, be a lower number in dollar figure, okay. And then based on everything, I would end up with a different NPV. The old NPV was 332,000, and the new NPV is 295,000. Okay, and then we have an NPV change in dollar figure. So we use new minus old. And since sale drops, then the new NPV is lower than the old one. So the change of NPV would definitely be negative. The sensitivity right here, okay, is called sensitivity analysis because we get a number for sensitivity. The sensitivity is a change of NPV in dollar figure divided by the change of that variable, which is sale, in percentage. Okay, so we have $4.575 thousand. Okay, what we really want to learn here is to be able to explain the sensitivity. If you have a number of a 4.575, you should be able to explain that. The interpretation here is that if the sales increase by 1%, then the NPV would increase by $4.575 thousand. Okay, so the uniform way to explain sensitivity, to explain elasticity, or any definition in such a kind is to assign 1 unit of a change for the variable and see what the other variable would change. So if sales increase by 1%, the NPV would change by exactly the amount of the sensitivity. We have done this in chapter 8 when we were dealing with beta for stocks. You will still remember that if the market risk premium changed by 1%, then the stock risk premium would change by 1% times beta, or beta percent. Okay, so that's the sensitivity analysis. And we can plot the numbers on the sensitivity graph. So basically, this graph shows you this horizontal axis is the percentage change of the variable. That's for sales. And then the vertical axis is the NPV. And we have a straight line which indicates that the sale and NPV has a positive relationship. So if sale increase, your NPV also increase. But this graph doesn't give us a lot of information. We just look at a positive slope curve, and that's it. So what's the meaning of sensitivity analysis? It does not make sense if you conduct sensitivity analysis just for one variable. Okay, if you just do the sensitivity of sales, it does not make sense. The only way that sensitivity analysis makes sense is when you analyze multiple variables at the same time. Okay, when you analyze multiple variables at the same time. So right here, we have a diagram from the table. And in this diagram, we have 6 variables that affect NPV. Okay, like a price, like units, like cost of capital, like cost of equipment, the fixed cost, variable cost. They all affect NPV. Okay, and they all have a line, a straight line on this diagram. So if you look at the price, this line, or we call it price line, it has a positive slope. So basically, if the price of the product increase, the NPV would increase. And the purple line, which indicates the units, if units increase, that means the company make more sales of products, the NPV also increase. And if variable cost, this blue dashed line increase, if variable cost increase in percentage, then the NPV would drop, means the company spent more money. Likewise, the fixed cost increase, the NPV would drop. Okay, and to complete the sensitivity analysis, we need to compare the slope. Basically, the slope is the sensitivity. The slope of the lines is the sensitivity. If you compare price and units, you would see that the price line has a bigger slope, okay, or the line is steeper compared to the purple line. So that means price has more influence than units on NPV. In other words, NPV is more sensitive to price than to units. For example, if a price and the units, they both increase by 10%, okay, they both increase by the 10%, but NPV would increase much more due to price increase than the NPV would increase due to unit change. All right, so the sensitivity is different, indicated by the slope. If you compare variable cost and fixed cost, although both lines have negative slope, you can still tell that the variable cost has a steeper slope compared to fixed cost. You see fixed cost is flat. So that means NPV is less sensitive to fixed cost than variable cost. Okay, so variable cost is more influential to NPV than fixed cost is influential to NPV. All right, so the flattest lines are for WACC and cost equipment. So when the lines are flat, basically means NPV are not sensitive to the change of these variables. So if the cost equipment increased by 20% or decreased by 20%, your NPV does not change much. If the cost of capital, WACC, increased by 10% or decreased by 10%, your NPV does not change much either. All right, so basically you can fire the entire finance team because the cost of capital here does not matter at all. So that's for the sensitivity analysis. And we also have another type of analysis that is called a scenario analysis. And in scenario analysis, we have the change not just for sales, not just for units, we have a change in multiple variables. You see, it's the change in more than one variables. And for example, in the Speedo case, okay, the swimming machine project, we have a base case when all the forecast, all the factors are correct. Okay, that's the base case. And then we have another case, the best case. In the best case, you see everything changed to the favorable direction, like sales increase, cost decrease, the salvage cash flow increase, and the cost of capital decrease. And we also have the third case, which is worst case. In this case, sales decrease, cost increase, and salvage cash flow decrease, and cost of capital increase. Everything changed to the unfavorable direction. So your job here is to get the NPV not only for the base case, but also for best case and worst case. So you will have 3 NPVs based on 3 cases. And then you will assign probability for each case. And then based on the probability of each case and NPV of each case, you will find the expected NPV and you will find the standard deviation of all the 3 NPVs. So that's the basic of a scenario analysis. In your Excel project, you will run scenario analysis using scenario manager function of Excel and then calculate the expected NPV and standard deviation of NPV. Okay, so in the Speedo case, you can see that the worst case scenario, your revenue drops, the cost increase, and you have a less salvage cash flow, and your WACC increased from 10% to 12%. So your NPV definitely is less. Okay, so basically you're gonna run the entire NPV process again. All right, but if you have everything set up in Excel, that's gonna be much easier. All you need to do here is just to change the numbers. Okay, let's say the cost equipment can increase and the sales can decrease. Just to change the numbers, and that's it. All right, so that's why I say this capital budgeting is much easier to do when you use Excel. All right, and the last method here, oops, I'm sorry. The last method here is the Monte Carlo simulation method. So basically, it is just a scenario analysis. The only difference is in this Monte Carlo simulation, you have more than 3 scenarios. You're not just having base case, best case, worst case. You have 1,000 and perhaps 10,000 scenarios. Okay, and each scenario has different numbers for sales, for costs, and then each scenario should have a different number for NPV. And then you would have 10,000 different NPVs from 10,000 scenarios. And then you're going to conduct analysis. Once again, you're going to calculate the expected NPV at a standard deviation of NPV based on these 10,000 NPVs. Okay, so it's just a much more comprehensive scenario analysis. Okay, It's based on assigning a wide range of values to multiple variables, including sales, variable cost, fixed cost, cost of capital, and the salvage cash flow. And then definitely you're gonna rely on the computer to do such thing because we would tire ourselves just by calculating 3 or 5 scenarios. So we have to use computer to do the job. And this Monte Carlo simulation is first applied in the pharmaceutical industry because such industry is a very risky industry, and the companies have to take care of their risk. Okay, so they have to do risk analysis all the time. So that's why they developed such advanced technique. So step of Monte Carlo simulation here is first we establish the base model. Okay, so we know that NPV is a function of sales, cost, and salvage cash flow. So this is would be a model we establish. So if the salvage cash flow change, the sales change, the cost change, it would definitely have a different NPV. All right, and then we would specify the distribution of each variable. So let's say the sales is normally distributed. You know, statistics class, you know what normal distribution means, right? It has a mean, it has a deviation. So the distribution is like a camelback curve. Okay, and according to variable distribution, you would draw one sample for each variable. So for sales, you would have a one value, and for units of a cost, you have another value, and then you calculate NPV. Then you do the step, you repeat the step for hundreds or thousands of times, and you analyze all the NPV. And I do have a example of a Monte Carlo simulation, and I have posted on your canvas. Okay, so right here, what you see is let's see, thousands. Okay, like 13,000 scenarios. Okay, so that's a simulated number. So we have 13,000 scenarios, and we have a revenue. Okay, the revenue has a mean of $10 and a standard deviation of $4. The cost have a mean of $5 and a standard deviation of $3, and the WAC has a mean of 10% and a standard deviation as well. And then based on these numbers, I can have an NPV. Ignore the change of these charts because each time I click, the charts will change because it regenerates the simulation for another time. So the NPV basically is the revenue you make here divided by 1 plus the discount rate, which is WACC, then you deduct the cost you spend at the first year. All right, so you're gonna have a one NPV for one scenario, and then you're gonna generate the revenue, okay, based on a normal distribution. So you can see in this column, you have different numbers. So these numbers are simulated based on a distribution with $10 average and a $4 standard deviation. Okay, so the machine just generated, simulated for 1,000 times. And likewise for cost, the cost has a average of 5 and a standard deviation of 2. So the computer also generated 1,000 times. Each time is a random generation. We don't know where it's gonna pick up the number. In this case, it could be 9. In next case, it could be a 7.7. The last case could be 1.5. Okay, it can be anywhere as long as follow the distribution. If you look at the revenue distribution, it's just like a camelback shape of a curve is right here. And if you look at the NPV, and we're gonna have a 1,000 NPVs for 1,000 scenarios, and this is the thing we're gonna analyze. Okay, so that's the distribution of NPV. Of course, we're gonna get the distribution. We're gonna get the average. We're gonna get the mode. We're gonna get the media and the standard deviation, everything. Okay, so at least we have an idea of the risk we're facing.